We have our final breakout panel now, and this session is titled Strategies for Optimizing Cyber Insurance and Mitigating Risk, and I'm going to ask the panelists to join us and get settled up on the stage. So for the panel today, we have Mark Wheeler, founder and co-CEO of Mosaic Insurance, Meghan Hannes, Chief Underwriting and Claims Officer of K2 Insurance, Gerry Glombicki, Head of Cybersecurity Common Interest Group at Fitch Ratings, and moderator Stephen Schwartz, VP of Insurance Strategy and Underwriting at Safe Security. So thank you guys all for being here, and enjoy the session, everybody. Thank you.
Awesome. Well, thank you guys for joining us. It's good to see that we have the hottest topic of the conference this afternoon.
It's a bit more intimate than
it is. If you guys want to get closer, by all means, we don't bite. As Luke introduced, Stephen Schwartz, lead insurance at Safe Security, and pleasure to have Gerry, Meghan, and Mark joining us here today. Before we get into it, just by show of hands, who here is involved in some capacity with your organization's cyber insurance process, renewal, whatever it may be? So 1, 2, okay, a few hands.
Majority of the audience.
Yes, all 9 people. Can you guys share in what capacity? Like, are you, driving the majority of the renewal process, answering the applications? Just any context you can share? Or you just hate it like all that much that you don't even want to talk about it, which I also understand. So it seems like the latter. It's a painful process.
I'll say something in the conversation. I'm involved in the technical response and the selection of the provider.
Okay, thank you. So as we get into this here now, let's take a step back for a second. I'd love to hear from, have each of our esteemed panelists introduce yourselves, and also, just as much about yourself, your company, right, and its relation and role in the cyber risk and cyber insurance ecosystem. And Gerry, why don't we start with you?
Sure. So I'm Gerry Glombicki. I've been a senior director at Fitch Ratings, based in Chicago, for almost a quarter of a century, being a credit analyst, covering cyber and technical risks for about a decade. I'm a little bit of an odd person. I'd say unique in the sense that I'm a certified public accountant, but I also hold several designations in the cyber realm, so I can talk equally comfortably to the CISO as well as the CFO and everybody in between. Because of that, I also head up the Common Interest Group at Fitch, which is about 50 people. We cover how to on a global cross-sector, how to look at cyber risk into all of our ratings, as well as we also house the Chief Information Security Officer and the Information Security team, and we also look at the best practices to also protect Fitch itself.
Awesome. Meghan?
Meghan Hannes, Chief Underwriting and Claims Officer for K2 Cyber. I am a career cyber underwriter and portfolio manager, which essentially means that I am the one responsible for drafting those applications that you hate, as well as ensuring that we've got cyber services, working with the actuary, making sure that the not only product is fit for purpose and tight within its 4 walls, and purpose-driven underwriting, but also ensuring that we maintain profitability. Prior to K2 Cyber, I managed the portfolio at Beasley, which is just under $1 billion of gross written premium, and prior to that, I managed the portfolio at Hiscox.
Thanks, Meghan. So Mark Wheeler, I'm co-founder and co-CEO of Mosaic. Mosaic's a specialty insurance company. We're in 7 lines of business, and cyber's one of our largest lines and fastest growing lines. My background and core competency is in underwriting. I've spent most of my life in and around Lloyd's of London. I currently live in Bermuda, which elicits very little sympathy whenever I mention that. But I describe myself as a fervent disciple of client differentiation, and that's one of the reasons why I was really excited to meet Stephen Sackett probably 18 months ago, I guess, about now, in a way of being able to quantify the risks that we were looking at in a very subjective way. So,
well, and to your point, Mark, I mean, the very laws of insurability, we have to be able to measure and quantify risk, right? So we would think it should be the starting point, right, or a core fundamental element when evaluating risk and certainly managing a portfolio.
Yeah. So I've always thought that anything's insurable if it's A, fortuitous, and B, capable of valuation. I think any insured peril really shares those two characteristics, and that again dovetails quite closely with the safe product. It's for us, it's I think literally a game changer in terms of thinking about likelihood of risk, magnitude of risk. So really excited to be a consumer, really excited to partner with you. I'm not sure if everybody's aware, but we've recently formed a partnership with Inside Risk where using risk assessment information from SAFE and aligning that with our underwriting capability, where we're out and making a primary market in cyber at the moment. So I'm very excited about that.
And sort of building off that, and I'm really interested to hear from all three of you, given the different perspectives on the market, how do you think about assessing cyber risk? Like at Fitch, how do you guys look at the world of cyber risk versus how Meghan is and Mosaic, so on and so forth?
Sure, it's a great question. So I think one of the things I can tell you, I've been, again, doing credit analysis for about 25 years, and I've yet to hear a CEO or chief underwriting officer tell me that they're purposely trying to lose money. I've yet to hear a chief actuary tell me that the reserves are short or their investments are bad as well. So everyone tells me they have a great program. And the hardest part is I can't really tell you if you have a great program or not because I'm not really sure what a great program is. Ultimately, it's bared in the financial statements. If a cyber event happens and you manage it well, that breeds great credence to your evidence of your actual credibility of governance of the actual cyber risk itself. That's not to say that just because you had a cyber event, you're bad, and just because you didn't have a cyber event, you're good. So it's really tricky to kind of look at this and how it's happened. Oftentimes, it's both a qualitative measure as well as a quantitative measure. I think one of the things a lot of people like to throw stones at trying to quantify cyber risk that it can't be done or it can't be done really well, or it's a very wide range of stuff. But when you don't use analytics to manage a risk, you suffer from a hippo problem, and that's the highest paid person's opinion is what's really going to dominate at that point in time. So what you really need to do is actually try to quantify the risk, understand the unknowns, and manage it around that. If you build a plausible story and demonstrate it time and time again, that's really good. One of the biggest things I tell companies is what I call calling your shots. If you can tell me this is going to be our budget, here's why we hit it, or here's why we don't think we're going to hit it, that's really important to me. And it's okay if you don't hit it, but as long as you can explain why. Is it competition? Is it pricing? Is you just mismatch this thing? It's okay, but you have to understand your market and demonstrate that. That's really the key crux.
No, and you bring up a couple interesting points there, right? From especially with the level at which you're looking at a given risk, and when we peel back the onion, deeper and deeper, if you will, on a given organization, and certainly at a portfolio level, in terms of, and where I'm curious, like Meghan, with what you've been building, like what are some of the, whether it's behavioral, technical signals, what are some of those items that you're looking at to really drive the needle, right? And that, the many attendees here may want to listen to and leverage as they prepare for their next renewal.
Yeah, to peel back the onion a bit, in both experiences, managing large portfolios, and this is a range of companies, SME all the way up to publicly traded. There was one theme that was the constant battle, if you will, for underwriting managers, which is that translative element from the application, which is an attestation, not fact, to the rating engine that had been in place for any number of years, regardless of the carrier that you're at. It's somewhat fixed in space, and you've got to work around that to then layer on your indicators of loss that are obviously coming from your claims department into translating that into what makes a good risk from a bad risk, and how should we price that, and where does it sit in space and relativity. And one of the reasons I transitioned to K2 Cyber, which is yet to be in market, but the things that we're looking at is just revalidating that trust factor in cyber insurance. And what does that mean? That means actually boiling it down to basics and what do indicators of loss look like but tilting it from the perspective of what can we get from a trustworthy perspective, rather than the things we want to ask just because they've been asked in previous years on renewal, and really establishing that trust in data. Because if you don't have a trust in data, and I'm really tempering myself because I could go on for hours about the risk in doing analytics on a portfolio when you don't have that translative trust at the basis. You really have to go back down to basics and say, okay, what can we get on a trustworthy basis compared to what are the themes that are commonly found in cyber applications, because we know that those are the themes, not necessarily, they're directionally impactful, not necessarily one-to-one, but directionally impactful on what causes attritional loss. Mm-hmm. This is attritional loss. I'm not talking about cat loss, but attritional loss. Mm-hmm. And sort of very long answer to your short question. We're looking at harnessing behavior, and what does that mean from a security perspective?
But you touched on two, and I think the two sort of primary, or two of the primary themes from my perspective, which is trust and transparency, right? Mm-hmm. And transparency begets trust, and the more transparent we are, how do I say this, right? In order to have more resiliency and more security holistically, we need to be more transparent, thus negating privacy. But that's the world that we live in now, right? And things have changed and are exponentially changing as we continue to shift into the matrix here. But when I think about too building off those themes and whether it's the role of the CISO, but even before we get there, like the role of the insurance ecosystem. Mark, how do we think about how we can partner more, whether it's at the carrier, at the broker level, with the CISOs, right, and customers in the room, so that it isn't viewed as this like one-time exercise we do year over year. That's super painful, like, oh man, here's this 300-question application again, but where we're focused on that continuous, risk equation together and elevating, the overall posture.
Okay, so I'd like to answer the question by taking a step back and thinking about the components of underwriting a little bit, and not the whole process. But essentially, the most important thing in underwriting is risk selection. Mm-hmm. I think we'd agree on that, Meghan. Mm-hmm. Second thing is the contract language. The third would be attachment point in a program. The fourth, how much capacity you're putting out. And then ultimately the price. And I say it in that order because you can't price something that isn't structured. So coming back to this point about selection, and really this is how I wanted to start answering your question. I started underwriting, I think, 36 or 37 years ago. And during my first week, somebody was explaining to me the importance of selection. And they sent me away and they said, I want you to, it was a syndicate that led a lot of banks business. And they said, I want you to go away and come back and tell me what the difference is between Wachovia and SunTrust. I'd grown up in rural Britain. I never heard of either of them. So I went to the library at Lloyd's and there was a SunTrust because there was no internet. I went to the library and there happened to be a report and accounts of SunTrust because they were a licensed deposit taker for Lloyd's premiums. They didn't have anything on Wachovia, so I phoned the broker. I ended up sitting on my desk with 2 annual reports. And that was pretty tough to divine any risk selection metrics from, particularly as a first weeker. Mm-hmm. So it was sort of putting financial metrics next door to each other. And I wanted to make that point because I've just been in a CISO session, which I was quite surprised at the cynicism around the safe product in terms of the actual accuracy of the output. Mm-hmm. And I just didn't want us to get too hung up around that because it's such a significant step forwards in effectively one professional generation. And to be able to start modeling cyber risk in this way, I think is really profound. To be able to take a view on likelihood of loss plays into those underwriting components. To have a view on magnitude plays into capacity and attachment. So I think it's really significant, and notwithstanding the cynicism, I think, would you describe it in that way as well? We, certainly at Mosaic, for what it's worth, are absolutely prepared to take a position on it and to price off the outputs, because selection hitherto has been so subjective, and now to have this objective position, we feel like it's a great step forward in being able to reward those insureds who are investing in improving their risk posture, which is something else I hear often. So I'm really excited about it.
I'll jump in there real quick.
Yeah, of
You
course.
mentioned something that was pretty good. I mean, all models are wrong. Some are useful. That's the quote that you often hear. And it's going to go directionally correct. I think, Megan, you mentioned it. Just really doing the basics. So, just do the basics right. That's a much better risk than not. And it's one of those things, there is no such thing as a secure cyber company. If you use the internet, if you use computers, there's always going to be tech risk. The question is, how do you get it to a manageable level? And that's really where you need the CISO, the board, and everyone coming together is, what is that risk statement? What is that risk appetite? Because at the end of the day, there's really 4 things you can do for risk. You can accept it, you can avoid it, you can mitigate it, you can transfer it. But you have to know what that starting level of risk is to put it into those right buckets. And that's actually where the insurance companies and the brokers can actually come and help understand that and place that risk and kind of give you kind of best-in-class indications of that. But if you don't have that fundamental starting point, everyone's going to be lost and everyone's going to be swimming in the dark. You need that common language, that common framework to start it. And that's what the model is, just that starting point. It's not the end point, but it's just the starting point.
Yeah, I couldn't agree more. Mark, I couldn't agree more. The applications right now as they stand, and I'm sure everyone in this room is frustrated with those applications because they're also the existing, and I'm talking the static pen and paper, they're also very much, they can set you up to fail, if I'm being very honest. I've mentioned this on a panel once before, and I think folks were rolling on the floor laughing, but very true story. K2.
It's quite good to get a laugh
K2,
on an insurance panel.
K2, yeah, K2. We have our own cyber insurance. The CEO of K2 Cyber is also the Chief Technology Officer of K2 Corporate. He's filling out the application, and we're a $1.7 billion company with gross written premium under management. And he's filling out the application of one of which I was responsible for. So he's cussing and swearing, and he's like, who wrote this piece of garbage? I can't compare one to the next. I'm a CTO. I can't answer these questions. Service accounts, yes, maybe. There's no maybe option. He's like, who wrote this? And I was like, me.
Oh, that was a big
right? So I had come from Beasley, where my team was responsible for designing this application. The point is, if the 2 people in the room, one chief technology officer and the other formerly responsible for writing that application, are having challenges, could we even imagine what our clients are going through, right? But the wider point to that is that application process right now, it's assumed to be truth because that's where, that's the framework of which we come from, but it just because, it made sense in a former life doesn't mean it needs to make sense going forward. And that's where that moving the conversation from this is truth to this is directionally accurate, but we need to go find sources of truth of which to anchor our underwriting assumptions. For me, the successful cyber underwriters of the future are going to understand what's important to them, what their anchors are, and what those anchors mean in the context of how do we harness the behavior of our how do we capture rewarding the behavior of our insureds, right? And that's not necessarily, it's not to say that SAFE is like, here's this black box blueprint that everyone must follow. You've got to have folks in the room who define what that framework means to them, to their portfolio, to their goals and objectives in this market, so that, and also downstream to their reinsurance partners.
And I think reinsurance is a really interesting point. It's one of the great inhibitors. The availability of capital is one of the big inhibitors to the development of the cyber market at the moment. I think the reinsurance spend globally is only about $7.5 billion. And in the context of other classes, and in the context of contemplated longer range tail risks, sort of 1 in 25, 1 in 50, that's quite a nerve-wracking base premium for a capital provider to get over. So I thought that was a really good point that I wanted to pick up on, the benefits of the modeling go beyond the insurance market. And capital's a commodity, and capital responds very well to models. Gerry and I were joking before the session that the excuse that you hear in cyber is there just isn't enough data. And there's as much data as you like over 100 years in property, but those models don't seem to get it right very often either. So it's more about, I think, a reference point that you can build from.
I'd say just related to that, though, I mean, cyber insurance is much different. So I always tell people, you see one cyber insurance policy, you've seen one insurance policy. You see one cyber risk, you've seen one cyber risk. So to put it in some context, a lot of people like talking about growth. So you've heard often that the cyber insurance market's about $15 billion globally. Roughly speaking, about 10% of that's in APAC, about 30% of that, is in Europe and Latin America, and the majority here is in the US. So everyone keeps talking about the growth rate. So for 2023, the year-end statutory data on a direct basis for the US market was actually slightly down. So it kind of doesn't necessarily put a damper on those growth rates, but you have to understand the dynamics behind it. So oftentimes there's really large companies, there's medium companies, and there's small companies, and the way they buy cyber insurance, the way they approach cyber risk is different. Some of them use captive, so actually more risk on the books, but they're actually using it in a slightly different way. It might be not picked up quite as well, whereas a small company might be going bare on the type stuff, and you're starting to get growth in these other markets. So it's really kind of hard when people talk about cyber insurance, it's this one-size-fits-all product and policy. That's not true.
The notion of, especially as, with the advent of Gen AI and the world we're headed into, the notion of the all-encompassing cyber policy is very scary. But two things that I'm hearing, right, is, and which I wholeheartedly agree with, if there is one certainty in quantifying cyber risk, it's that there's absolutely no certainties. Right, there will never be a correct answer. Like, oh, that's right, until a loss happens, and that model may have happened to predict it, with a very close correlation. But more so, right, when you change the way you look at things, the things you look at change. Right, so, and I think that's in part what we're speaking towards here, right, on the underwriting ethos, where, for those of you who don't know, the majority of the cyber insurance market today is truly underwriting in a fog, a fog with like tinted windows as black as possible. It's like underwriting this significant commercial building by just typing the address into Zillow and using the data you see there to underwrite commercial property, without validating that there are sprinklers, there's a centrally stationed alarm, there's no cracks in the ceiling, right? So how do we get there in cyber now that technology's caught up that we don't need to install a black box, right? We can correlate it back with policy incentives so that what's in it for you, for the end customer. But it's really, how do we think about bridging that gap? Do we think that there's a future state where cyber, the security leadership can have more of an ownership role in cyber insurance? And can insurance be used as a mechanism to help validate, a CISO's effectiveness?
Yeah. Steve, you bring up a really good point about how do we support our CISOs, right? So the model as it stands today, and when I say the model, I mean just the cybersecurity insurance renewal, it assumes an opt-in model. And what do I mean by that? It assumes that you're ingesting all of the things that we're giving you as a carrier to thus improve your risk profile. And anyone sitting in this room will know, like, well, that's not necessarily not only true, but like you've got your own internal ways of managing risk. And we as an industry need to do a better job at quantifying your efforts. And I know I'm oversimplifying that, but quantifying your efforts as opposed to an opt-in model, because then that's the space where we can really maneuver with, I don't want to call it reward, but either a limits profile, a reduction in premium, a retention. That's the space we need to reinflate that's really been compressed down by assumption.
Yeah, I would jump on it and say questions often asked is, who's the responsible for the cyber risk?
Yeah.
And I'd argue that it's the CEO is ultimately responsible for the cyber risk as well as all risks in the company. Now, certainly the CEO may not have the technical knowledge and expertise to actually buy the cyber insurance.
They may not be
type stuff.
treating it, right?
Right,
Mm-hmm.
but they're the ones who are ultimately responsible. They're the ones who have to go to the board type stuff. And that's where actually the CISO can come into play. And they have to be able to speak the language of business that everyone talks about. And again, being an accountant, I'm going to be biased and say the language of business is accounting. And that's how it actually is used, that's what runs the financial statements. That's what it comes to. A lot of people talk about how cyber isn't a cost center, or it is a cost center type stuff. But the biggest point is what you have to do is you have to get knowledge and information to the people who actually are responsible for the data, responsible for the risks, and manage it appropriately. And the companies that can do that over the long run will be more successful at it than not. And again, it's okay to be wrong. You just have to learn those lessons quick. And ultimately hope that you don't get hit by something severe. But that's really what it's coming down to. You look at the evolution of cyber risk, it's certainly changed. And a lot of people like talking about AI. And I think people who talk about AI don't understand exactly what AI is or what it does. It's not a silver bullet. Same thing, the cloud isn't a silver bullet itself.
It's up there.
Right. So when people start talking about those things, they just throw those buzzwords around there. That's a big red flag to me, that people don't know actually what they're talking about. And that's actually where I get a lot more concerned about risk.
Mm-hmm. Agreed. Yeah, I haven't heard big data in a while.
Yes.
But
Steve, I think it's quite telling, and thanks to the CISOs who've turned up, I think it's quite telling how few CISOs from the conference have come to a session on insurance. And there are a couple of observations over the last couple of days where Saket put up a slide yesterday saying the digital security industry is worth 200 billion, and our industry is 15 billion. We're sort of six and a
we're
half
such a small
percent
microcosm.
And I think that's probably partially reflected here. But I think it speaks to the ownership piece as well, and what sits with risk management, what sits with CISO. And it would be great if we could close that gap a little more. I think it would be phenomenal if we could use tools like the SAFE tool, to your point, to validate the value of the output, and for our industry to be able to truly differentiate and reward clients who are investing and demonstrate a culture around risk management.
Now, this is a question that I have personally for your guys' thoughts. How do we break through when, we at SAFE work with security leadership predominantly. And I might meet with said security leader who would be very happy to not go through the traditional application process and leverage our carrier partnerships, right? And click a button, if you will, to share all the underwriting data that's required. Yet at the same time, or a month later, you have their broker, who's 8 out of 10 times is their account rep, not the cyber team necessarily, who's going to push forth the process that they want to push forth and engage the markets that they want to engage, right? So it's it's not a direct question, right? And it's a problem and challenge that we're all trying to solve. How, beyond getting the alignment within an organization, how can we get our industry just aligned, so that when we're all trying to deliver value, right, for the end customers, build a resilient, sustainable ecosystem, but we're all doing so in our own vacuums to a degree, if that makes sense.
Yeah, there's some low-hanging fruit there. I'll play back kind of the problem statement, right? The problem statement is such that we as an industry just inundate CISOs with static applications, and we do that same process year on year on year. And the historical rationale has been, well, what if something's changed? Is that the right question, right? And to your point, imagine a world, and this really doesn't work, this really doesn't exist today to my knowledge. Imagine a world where, well, what if something has changed, turns into what are the 3 things that we want to know about behavior or a pattern, right? Because patterns are where the truth lies can lie in terms of directional accuracy. And so taking that And what's the most painful part of insurance? Is the renewal, right? Most often. And so how do we start bringing those two concepts together of, it's our responsibility as the insurance industry to say, what do we need, right? Because I think that's where also we can do a better job to the CISOs, in the room and elsewhere, what do we need, as opposed to largely having them guess at what we think we need. And then translating that into something meaningful, which is less pain.
Yeah.
Right?
Yeah.
Well, I think that the safe approach is, these are early days and first steps, but it's a really good start at collating data in a standard format. And I think as that becomes more widely accepted in the mutual community, then that's going to be information that people will feel comfortable relying upon.
Yeah.
Well, I think it goes back to the risk. I mean, how many people would argue that cyber risk today is the same as it is tomorrow, let alone a week from now?
Exactly.
And the hardest part is when you're underwriting it typically for a year. So you're trying to guess what's that risk going to be over 365 days, when you can maybe argue it's kind of like predicting the weather, for the 365 days with great accuracy. That's really what it comes down to. So there's a lot of data that people are asking for, not really sure how it's going to be used. But at the end of the day, you kind of look at most of the cyber claims or most of the cyber risks, about 85% of it actually comes from humans and human error. And how do you actually price that into the models as well? The point being, cyber is going to be a dynamic risk. It's going to be some pain points for us a while to actually get this. The question is, how do you do it in the least painful way process? And it goes back to your earlier theme of transparency and trust in the data. You start with that. You start with the common framework. You start with the common language, and it will build. It's going to be a process. It's going to take some time. There's going to be pain in the process, but that's the starting point.
Yep. No, couldn't agree more, right? And we've seen this in other lines of business, right? Within insurance, your steam boilers, or for those who know of affiliated FM on the property side, or telematics. This isn't a new idea, right? But now bringing this to life and with a very complex dynamic risk.
Well, I'll go back to car insurance. There's the jingle of 15 minutes can save you 15% more, right? But you look at actually the use of telematics. There's actually, within telematics itself, there's a large carrier who has stated publicly that with telematics, the way they price the risk, it can actually be a 20% benefit to the user to a 40% surcharge. So even with all that sophistication that they had beforehand, that's the gap on just auto insurance. Just imagine what it is for a more complex risk.
Well, and you bring up a good point, right? It's pricing to the risk. Right now, we're having to price to market, right? And everybody in the room has to feel that pain when we have significant claims activity, like we did, 2-3 years ago. As we get to price to the risk, we reduce that year-over-year volatility, but that doesn't necessarily mean that it's going to be better pricing than what you have today.
That's right.
Especially in the current rate environment. But it's a very, very interesting point, just in this paradigm shift.
But the industry's clearly got pricing broadly right. If you look over the past decade, the return on capital in cyber markets been somewhere between 10 and 12%, which, based on the tail risk that's manifested, that's not too bad. But maybe it's just because over the last 10 years, some of those anticipated 1 in 25s, 1 in 50s hasn't materialized, in which case it wouldn't be enough, but the market will respond in the normal way there. I thought Gerry's point about the continuum of risk was really important, and that's another reason why we're enthusiastic adopters of SAFE as a source of information. And they're not paying me any money, we just really are very enthusiastic about it. And it's going to change how we do business. But the knowledge that there's an ongoing evaluation of threat and the exposures faced by our insureds, and the knowledge that those CISOs are going to be equipped with that information in close to real time is a great source of comfort to us. It's not a matter of binding the risk and hoping and waiting for the renewal. We feel just pretty good about how that risk posture is evolving over the duration of the contract.
And to your point, having that mechanism to engage throughout the year, right? Not just 9 months from now, to your point, Mark. I know we're coming up on time. I don't know if there's any closing remarks from the panelists or any burning questions from the crowd.
It's
Think
tough
of a
to
question.
compete with the bar.
It is. It is. I'm trying to think of a question. How do we spell cyber insurance? But no, in all seriousness, thank you guys for joining us today. And thank the room for joining the cyber insurance panel at the end of the conference here. Next year, we're going to make sure that we're a little earlier so that we get the room full. Because and all jokes aside, it's, people forget, without insurance, the world stops, right? We're only shifting into more of a digital operating environment, right? We're not in this building without insurance. We're not working. We're not driving cars, right? So as we continue to usher into this digital era, it's going to continue to be more and more paramount that we have the appropriate constructs, appropriate asset protection to enable us to grow, right? And in a sustainable way, both organizations and the insurance ecosystem. So we need to have more of these conversations together so that we collectively solve the pain that we're each uniquely dealing with, if that makes sense.
Thank you, Steve.
Thank you.
Thank you. Yeah.